Sunday the 16th of August 2026, and here is the number that matters. The crypto market has not dipped, it has lost about 45% of its value in 1 year. Total market capitalization fell from $3.98 trillion to $2.18 trillion, wiping out roughly $1.8 trillion. That is not a normal pullback, that is a full reset. And out of that reset, investors are changing how they pick winners. Instead of pointing at the biggest market caps, they are asking a much more basic question: what does this asset actually do? Today, CoinDesk reports that crypto investors are looking past market cap rankings and back to fundamentals. That shift, coming after one of the sharpest drawdowns in the asset class's history, could mark the end of one era and the start of another. Here is the problem with market cap: it sounds like value, but it is not. It is simply the price of one coin multiplied by the number of coins in circulation. That means a token with a tiny float and a high price can look enormous while very little money actually backs it. In traditional finance, investors look at earnings, cash flow, and assets. In crypto, for years, many people just looked at the ranking table: Bitcoin at number 1, Ethereum at number 2, and so on. But a ranking table tells you nothing about revenue, user growth, developer activity, or whether a project is actually used. The current snapshots show Bitcoin around $65,000, Ethereum near $1,931, and Solana at $73.87. Those prices are real, but they do not automatically make them the best investments. After a 45% market collapse, that lesson is finally landing. Several signals this week point to the same conclusion. The Bitcoin Foundation published a piece on Sunday saying Bitcoin is losing its grip on crypto, especially among American investors who are looking beyond the flagship coin in 2026. CoinDesk followed hours later with the fundamental shift headline, and CryptoRank reports a Chainlink analyst target of $11, with the bull case built on Oracle network adoption rather than market cap rank. Meanwhile, Grayscale's 2026 outlook calls this the dawn of the institutional era. The common thread is clear: after a year of heavy losses, both retail and professional investors are asking harder questions. The old buy the top 10 strategy is giving way to due diligence. Instead of asking which coin is biggest, people now ask which coin earns fees, has users, and solves a real problem. Let us put some numbers on the table. The total market lost $1.8 trillion in value over 12 months. Yet within that rubble, performance has been wildly uneven. Bitcoin still leads with a market cap around $1.3 trillion. Ethereum sits near $233 billion, Solana near $43 billion. But market cap did not protect anyone from the drawdown. What is now moving prices is the fundamentals underneath: daily fees, active users, treasury revenue, and whether a token has a reason to exist beyond speculation. That is why the conversation has shifted from which coin is biggest to which coin is actually making money. It is also why analysts now talk about fully diluted valuations, vesting schedules, and fee capture instead of just supply and price. One name keeps appearing in the data: Hyperliquid. Over the past 90 days, Hyperliquid has gained 33.85%, even as the broader market suffered. It is the best performer among cryptocurrencies with meaningful market caps, with a market value around $14 billion. Why does that matter? Because Hyperliquid is a decentralized perpetual trading platform that generates fees from actual trading activity. Investors are not buying it because it is number 7 on a list, they are buying it because the platform's activity creates revenue. That is a textbook fundamentals trade, and it is the clearest example of the new filter. When a market-wide crash punishes speculative tokens but rewards a fee-generating protocol, the message is unmistakable: substance now beats size. This shift is already affecting behavior, and you can see it in the way investors talk. Retail investors who used to buy whatever token had the largest market cap are now reading white papers, checking revenue, and comparing fees. Institutional allocators are doing the same, with Grayscale's report pointing to a more mature, fundamentals-driven market. U.S. investors in particular are moving beyond Bitcoin, as the Bitcoin Foundation noted this morning. That does not mean Bitcoin is finished, it remains the largest asset by far. But dominance is no longer the only story. For altcoin projects, the pressure has changed. You cannot just promise a big ecosystem, you have to show users, fees, and real-world utility. For investors, the lesson is that a ranking table is not research. So where does this go next? Near term, expect more separation between tokens with genuine cash flows and tokens with only narrative. The UBS note on AI themes says markets can become too pessimistic, which suggests selective recovery is possible when fundamentals improve. BlackRock's weekly commentary also points to a focus on earnings and quality across asset classes. In crypto, that translates to watching fees, active addresses, developer commits, and institutional adoption rather than market cap position. If the total market is stabilizing after a 45% reset, the next leg higher will likely be led by assets that can point to actual usage. Hyperliquid's 90-day gain is the preview. The old top 10 list is becoming a starting point, not a strategy. Here is the takeaway for Sunday the 16th of August 2026. Crypto just endured a 45%, $1.8 trillion drawdown. That pain has forced investors to look past market cap rankings and back to fundamentals. The assets that survive and thrive will be the ones with real users, real fees, and real institutional interest, not the ones with the largest fully diluted valuation. This is not just a bear market story, it is a maturity story. For you as a viewer, the practical step is simple. Do not ask whether a coin is big, ask whether it earns. Size can vanish in a year, fundamentals are what remain.